Well, it's been a massive few days for global markets, with a new Fed chair nominated, with an Australian RBA rate rise, and with plenty more to discuss. So it is the Traders Circle Weekly Market Update. It's Tuesday the 3rd of February, already in 2026, and before I start, you do need to be aware that whatever I say is general advice only. The big news over the last few days is that Trump has announced his nominee as the next Federal Reserve Chair, the man to replace Jerome Powell. And initially, markets were shocked. Trump nominated Kevin Warsh, a former Federal Reserve Governor himself, who, at least when he was a Fed governor, was quite hawkish a lot of the time. He favored trying to fight inflation, he favored lifting interest rates, and that was really not what the market expected at all. As a result, we saw a massive drop in a lot of risk assets. A lot of these risk assets are extremely high in price, and one of the reasons that they're high in price is because there's endless US government money printing. You know, the US dollar is being massively devalued, and part of that is lower interest rates. If a Fed governor comes or a Fed chair comes in and lifts interest rates, that could restore a bit of value to the US dollar, and it could turn some of those precious metals prices, cryptocurrency prices, stock prices, it could cause them to sell down. So the market was, like I said, initially quite surprised that this was the man that Trump has nominated. However, after that initial shock and that initial big move in a lot of risk asset markets, a lot of people then went to look at his more recent comments. In fact, Trump himself said, if he doesn't cut interest rates, I'm going to sue him. And Warsh's more recent comments have been a lot more dovish, a lot more favoring lower interest rates. And that allowed, a bit of a rebound overnight, a bit of a rebound in precious metals, a little bit of a rebound in shares, and so on and so forth, as investors basically, became convinced that he probably would toe Trump's line and try and force interest rate cuts. That's not a good thing. Just because prices went up doesn't mean it's a good thing. Prices also went up in Germany in the late 20s and early 30s, 1920s and early 1930s. Prices also went up in Zimbabwe from the mid 1990s onwards, and that's basically because they had periods of hyperinflation. They risk a similar thing being triggered in the US. In fact, I would argue that there are signs it's already happening, that the US is in massive inflationary environment. Now, obviously, that's not exactly the case from consumer prices, but I would argue that's because the wealth over there is currently extremely unequally distributed, especially the new money that's being created. Where we are seeing extreme levels of inflation is in risk assets. We've seen gold more than double its value in the last 18 months. We've seen cryptocurrencies skyrocket, share prices skyrocket, house prices skyrocket. So there is extreme amounts of money being created out there, and it is inflating prices, but just in risk asset prices rather than consumer prices, because consumers aren't sharing in that new money being created. It's all flowing to the very top. A little bit different here in Australia though, and today the RBA lifted interest rates. A little bit unsurprising. Most of the market had predicted the outcome, that they were going to lift rates today. And basically, they are going a different route to what it seems the Fed is going to do in the US, at least with Trump's nomination. We had the rate rise, and the RBA has said they're going to combat inflation. They're going to target inflation, they're going to lift interest rates to prevent it getting out of control, they lifted them by 0.25% today. They didn't really say too much in the accompanying statement, and really, they never really do say too much, to be honest. They've tried to become more transparent, for one, and they've tried to become more explanatory and more black and white. And despite those efforts, they certainly haven't succeeded. Basically, it seems like each and every month they have little clue what they're going to do, and they don't know what they're going to do after that either. Today's statement did leave the door open for further interest rate rises as well, but at the same time we have seen the Australian dollar rise quite strongly, and that could reduce imported Australian inflation. Regardless, I think they did have to lift rates at this meeting. You could argue that maybe they were perhaps a little too slow in lifting rates even, but things were looking a bit mixed late last year, and it's only really the more recent data in January at least that the inflationary story is looking pretty black and white. The RBA is only sort of one side of the inflation coin, though. You know, the other sort of, well, I guess there's another couple of sides, and those other sides involve fiscal policy and then, you know, corporate activity, and they don't really have as much control over those. So they are trying to battle inflation. That does show a bit of a different path for the Australian market. We did see the Australian dollar strengthen a bit afterwards, and that should be really unsurprising. I wouldn't be surprised at all if in the next couple of years the Australian dollar returned to parity against the US dollar, because they really are, you know, washing away the value of the US dollar, whereas the RBA basically is saying, you know, we're going to defend the value of Australian money, and we're going to try and, you know, fight against its devaluation. That's good news for you know, a lot of people who say earn salaries or can't afford risk assets, but less good news for people who are risk asset holders in the Australian economy. Finally, I wanted to touch on earnings. In the US, they're currently in the middle of their company earnings reporting season, and in Australia, we're about to go into our own company earnings season. There are some pretty big US company earnings this week, a lot of AI-related stocks. We saw a terrible AI-related report last week with Microsoft. They fell a bit over 10% after announcing their report. We did have a bit of a better report from Facebook or Meta, and then this week we're going to get Google and Amazon. AI-related stocks are now about 30% of the US stock market, and that's only increasing. So these reports are very, very important as to whether their market keeps going or not. Overall, the headlines are going to say that they beat expectations because those expectations are rigged to be beaten. But you know, if Microsoft's report is anything to go by, a lot of these companies aren't translating huge capital investments in AI infrastructure into improved earnings. And to be honest, I wouldn't be surprised if there's a little bit of disappointment in some of the, you know, perhaps Google, perhaps Amazon's reports as well. Following that, starting next week, we've got the Australian company earnings reporting season, and that will be really bad relative to share prices. That will disappoint. The Australian earnings reporting season is going to be terrible. It's going to be terrible given that earnings aren't going to show much of an increase for the past 4 years, yet our share prices are about 30% higher than they were at the beginning of that period. There is a huge disconnect between the performance of local shares and the financial performance of local shares, and then the performance of their share prices. Massive disconnect. Obviously, it's being led by, you know, that US money printing, that US investment, but never before, I believe, has there ever been a bigger disconnect between how well our companies are performing locally and their share price performance on the stock market. Their share prices have massively overperformed how underwhelmingly poor the underlying businesses have performed. So that is something to look forward to. I imagine we'll see some pretty big drops at certain points throughout this earnings season from individual stocks. If you are looking for a trade or investment on a stock in the next month or so, make sure you first check the company reporting calendar. Check if there's a reporting date that could affect your trade. We do have a Traders Circle reporting calendar, and they will link it at the end of the newsletter blurb that was sent out today. So let's have a quick look at the charts for this week, guys. This is the US S&P 500, and they rebounded overnight. As I mentioned, the market had a bit more confidence that Kevin Walsh was going to toe Trump's line and cut interest rates, and that pushed them back up to the all-time high. They were led by AI-related stocks, and yeah, a lot of those AI-related stocks reporting this week. So we're looking for a break of this triangle pattern. We've got an ascending triangle with resistance at 7,000 and this short-term uptrend line. The next break of one of those lines, that resistance or that uptrend line, will indicate the next directional move for US shares. If they break above 7,000, it'll be to the upside. If they break below that uptrend line at 6,900, we should see some further selling. If we have a quick look at the Australian market this week, and we can see that we've had some pretty volatile moves. Our move on Monday, which is this big red bar here, that came after you know, the Kevin Walsh announcement, big drop in crypto, big drop in gold and precious metals, drops in other things, and our market really hit the sell button, sell first, ask questions later, and then as US markets rebounded overnight, we retraced that selling. We pushed up to around 8,900 today, but with the rate rise, we weren't able to maintain the strength, and we pulled back off a little bit. Technically, we're also in a bit of an uptrend. We've got this sort of short-term uptrend line here, intersecting yesterday's low. We've also got some resistance at 8,900, and then the next level probably around 9,000. Our market technically does look bullish, but it's hard to see much further upside from here. Every time there is a little bit of negativity, we do tend to see some pretty strong selling. And as I mentioned, we're about to head into a company earnings reporting season where the company earnings are going to be pretty poor. So yeah, during the month of February, that was when we started selling off last year. It could be a bit of a profit-taking period for our market again this year. Although again, we could be surprised to the upside if analysts have under-expected or under-guessed company results in Australia. Alright guys, I will wrap it up there for this week. Hopefully you enjoyed. It's been a pretty wild week. Hopefully that led to some success for some of you out there, and I'll catch you guys next week.